we go. We have already finished two we have finished two financial statements, income statement and the statement for owner's equity. Well done. I mean, we've done great so far. Normally you would need at least a whole semester to be able to do this, but in a very simple and overly simplified way, I would say, we managed to see the connection between two income financial statements. Now we have to go to the balance sheet. This is probably going to be very easy for you, and here you can also at the same time apply the accounting equation, because again each side has to be equal to each other, so total assets to total liabilities and equity. Now we are starting from the top, and we're going to go now through most of these lines of information, right? So first things first, we invested 5,000 as a capital, and in this case we have the movement in the cash, which is 5,000. So we can just leave it like that and move on to the second half of the entry, which is the contributed capital, which also increased by 5,000. Yeah, so 5,000 here, 5,000 in cash. On the next line, we can see that the business has borrowed 20,000 from a bank to buy a printing machine worth $10,000. Now we can immediately enter both of this information into the cash. So borrowed 20,000, meaning our cash increased 20,000. Yeah, and immediately we assume that they immediately bought $10,000 worth of printing machine, which reduces our cash by 10,000, which means that our cash is by now 15,000. Yeah, so you can look at the formula here on the top. 5,000 plus 2,000, 20,000 minus 10,000. Yeah. Now we have to finish the other sides of these transactions for both. So borrow 20,000 from a bank means cash increased, but we also have an increase in the bank debt of 20,000, which is entered under the liability and equity to the bank debt. And the 10,000 increases also, so we had reduction in cash, but increase in the other type of asset, which is a printing device, and that's $10,000 worth. Now, because we're doing this financial statement at the end of the month, when the expenses have incurred, we because this is a printing device is a machine that has a depreciated value, and depreciation expense has already incurred. Here we can see it. So now our printing device at the end of the month, not at the beginning, at the end of the month, is now worth less by 375. So 10,000 minus 375. Now its current price, that in our books, it's 9,625. Its depreciation expense has been recorded in the income statement. Okay, that's it. Now the next one is paid 6,000 rent in advance. So the payment of $6,000 of rent implies reduction in cash. So we do it here. We follow with the formula minus 6,000. And so $500 worth. So the rent has been expensed $500, but we have $5,500 worth of prepaid rent, and we have to record it in our assets. Yeah, in the prepaid rent space. And moving on, the company A ordered to print pamphlets and flyers for 10,000 on credit. So here obviously we don't have any cash that we gain, but we do get account receivable. So we received an order. We didn't get a cash, but we received a promise to get back that cash, and that is 10,000 in the account receivables. The same goes for the company B, which ordered to print menus for $5,000. So we increase it also by 5,000, and so in total we have account receivable $15,000. Next we have payment to the employees, $2,000. Oh, sorry. I forgot this line. I think yes, I did. Individual customer order total 5,000. Again, I repeat, when it's not mentioned that purchase or payment or sale was done on credit, it automatically implies cash. Yeah, so this line doesn't mention anything about on credit, so it automatically means that this sale was done on cash. So we increase our cash by $5,000. That's it. And so we have left only $2,000 payment to employees, which reduces, yeah, it reduces our cash. We paid cash to them. And the last line is spent $1,000 worth of paper. Sorry, $1,000, meaning that obviously we spent $1,000 to buy paper and then we use it. Yeah, so 11,000 is our cash. That's it. So the reason why we cannot do any other entry here is because it's not really inventory. It's such a quick, so paper, yes, we spent it, yeah, minus 1,000, but we didn't have any other entry on this side or even here, because that's type of an inventory that sort of goes away really fast, so you don't even have a time to enter it. And again, we're assuming that we are doing this balance sheet at the end of the year, and we probably spent $1,000 worth of paper and we used it already, so there is no inventory left to record in the assets section. So that's why there's only that. Now here you can see we have finished with the entries. Now we can just summarize our total assets by using either the formula or just some function. Excuse me, froze just for a second. So let's use the function formula and add up our total assets here. Yeah, so total assets are equal 41,125. Now, if we summarize our liability and equity, you can already see it just automatically that the sum is not coming. It's not going to be right, and so there is a disbalance. But as you can see, we are missing one information from the retained earnings from the liability and equity section, and that is this. So the moment we enter the retained earning information, which is 16,125, we can use it from either here or here, doesn't matter. We just need a net income information, and that is 16,125. And the moment I will hit enter button, the total liability and equity will be equal to total assets. That's it. So we have our balance, we have compiled the correct balance, we have made our entries correctly, and so far everything is gold. Yeah, everything is correct. So that's the end of our balance sheet. And again, we can actually color code it to make sure that you understand the link between these three financial statements.